Good day, everyone. Together with my group mates, Kay Sulfay Talaman and Les Andre Nisahon, we are tasked to discuss to you the differences between the PFRS for SMEs and the full PFRS for equity and share-based compensation. So let's go first with equity. Equity is discussed in the standard for equity is covered by PAS 32 in the full PFRS while it is discussed by PFRS for SMEs section 22. So let's go now with the definition of the equity in the full PFRS. Equity is defined on a residual basis as the excess of assets after deducting the liabilities. For PFRS for SMEs, it is defined on a residual basis also, but with some additional information. This additional information pertains to the components included on the equity. These are investments by the owners of the entity or the share capital, the earnings through profitable operations and retained for use in the entity's operation, which increases the equity, and then the reductions to owners' investments as a result of unprofitable operations and distribution to owners, which is deducted from the equity itself, in the total stockholders' equity. Then, for full PFRS is defined on the PFRS glossary, while the PFRS for SMEs is in the section 22.3. Then, as for the issuance of equity shares, there is a similarity in both the PFRS for SMEs and full PFRS. However, PFRS is not explicitly stated as it is on PFRS for SMEs, since it stated that equity instruments are measured at the fair value of the consideration received or receivable net of direct issue of cost. PFRS for SMEs 22.8, while again for the full PFRS PAS 32. Then the other similarities of full PFRS and PFRS for SMEs and equity. These are the issuance of treasury shares, compound financial instruments, and putable financial instruments and obligations arising on liquidation. First, let's go with treasury shares. Treasury shares is defined in both for SME section 22.16 and PAS 32.33 as the equity instruments that have been issued and reacquired by the entity. An entity deducts from the equity the fair value of the considerations given for the treasury shares or the reacquisition cost. Recognition, it does not recognize a gain or loss in profit or loss on the purchase, sale, issue, or cancellation of treasury shares. This is both pertains to both full PFRS and PFRS for SMEs. Then let's go now with compound financial instruments. Compound financial instruments are those financial instruments that contain both the liability and the equity components. In turn, the management, when they issued this kind of financial instruments, they should allocate the proceeds received between the liability and equity components. And this allocation cannot be revised in the subsequent recognition. And last similarity between the full PFRS and PFRS for SMEs is the putable financial instruments and obligations arising on liquidation. These financial instruments and obligations impose an obligation to the entity to deliver a pro rata share in net assets when the entity is on liquidation. This can be classified as equity if the definitions of equity are met. That's all for the equity portion of this discussion. So let's go now with Bless Andre Misahon to discuss to us the share-based compensation.
Thank you for that, Steven. So I will discuss the share-based compensation for equity settled transactions. So there are differences in the measurement of equity settled share-based transactions between full PFRS and PFRS for SMEs. So first, what is the definition of share-based compensation? So a share-based compensation plan is an established established compensation for arrangement with the entity whereby its employees shall receive shares of capitals in exchange for their services or the services they rendered, or the entity incurs liabilities to the employees in amounts based on the price of its shares. So compensation plans such as these are usually used to motivate employees to perform well. So equity settled share-based compensation, by definition, it is when the entity issues equity instruments in consideration for services received. So under the share-based compensation, I will also discuss the recognition when there are vesting conditions. So if the share-based payments granted to employees vest immediately, the employee is not required to complete a specified period of service before becoming or before they are entitled to those share-based payments. In the absence of evidence to the contrary, the entity shall presume that services rendered by those employees have been received. So on the grant date, entity shall recognize the services in full with a corresponding increase in entity, of course. So while if the share-based payments do not vest until the employee completes a specified and do not vest so until the employee completes a specified period of service, the entity shall presume that the services to be rendered will be received in the future during the vesting period. So the entity shall account for those services as they are rendered by the employee during the vesting period. So with a corresponding increase in equity as well. So next slide is the share option. So as what I have mentioned earlier, one example for equity settled share-based compensation is the share option. These share options are granted to employees to enable them to acquire shares of the entity in a specified period with of course fulfillment of certain conditions. So under this, I will discuss the difference in the measurement of compensation for full PFRS and PFRS for SMEs. So there are two methods of measurement of share options for full PFRS: the fair value method and the intrinsic value method. So on the fair value method, the compensation is measured at the fair value of the share options at the date of the grant. If the entity cannot reliably estimate this, this is where the intrinsic value method is used. So by definition, the intrinsic value is the excess of the market value of share option over price. So for example, an entity granted by 15,000 share options to employees, but the fair value is not it cannot be reliably estimated. So the given is that option price is 150 and the share market prices is 175. So given this, 175 deducted by 150 is 25. So the intrinsic value of share option is 25. So well, for the measurement for PFRS for SMEs, the share option must be measured at fair value on the date of grant. The intrinsic value of the share option is not mentioned as an alternative, so this is the difference. For the full PFRS, intrinsic value is used if the fair value is not, it cannot be reliably estimated, while for the PFRS for SMEs, intrinsic value is not mentioned as an alternative. So next slide shows another comparison between the two. So under the full PFRS, transactions are measured at fair value of goods or services received. If the entity cannot reliably estimate these fair values, which is deemed always to be the case for the transaction with employees, these transactions are measured at fair value of the equity instruments rented. So this is the same for the PFRS for SMEs regarding transactions with non-employees. Meanwhile, transactions with employees, transactions in respect of goods or services rendered from employees are measured at the fair value of instruments rented. So the next part of our report is about the share-based compensation for cash settled transactions, which will be discussed by Kesa.
Okay, so moving on to share-based compensation under cash-settled transactions. So there is no difference between the full PFRS and the PFRS for SMEs. So the best example of a cash-settled share-based compensation is the grant of share appreciation right, where it entitles an employee to receive cash equal to the excess of the market value of the entity's share over a predetermined price for a stated number of shares. So in other words, a share appreciation right entitles the employee to a cash payment equal to the increase in the price of the given number of shares for a given period. So like a share option, a share appreciation right is viewed as a compensation for services rendered. However, unlike a share option, the entity recognizes a liability because the entity has an obligation to pay cash in the future on exercise date. So in short, share appreciation right creates a liability. In measuring the compensation, so it is based on the fair value of the liability at the reporting date and remeasured at every year end until it is finally settled. So the changes in fair value are included in profit or loss. And basically, the compensation is the cash paid by the entity, and this is known only on the exercise date and not on the date of the grant. So, in the recognition of the compensation, if the share appreciation vests immediately, the compensation is recognized immediately on the date of the grant. If the share appreciation does not vest until the employee completes a definite vesting period, so the compensation is recognized over the vesting period. So all of this are the same in both the full PFRS and the PFRS for SMEs, and we have here the summary of that for the measurement and the recognition. So there is no difference under the cash settled transactions for both the full PFRS and the PFRS for SMEs. Now we also have what we call the cash and share alternatives, where it allows the employee a choice as to whether to settle their transaction in cash or by issuing equity shares. So we have here the difference on the full PFRS and the PFRS for SMEs here on this table. So in full PFRS, accounting depends on which party has the choice of settlement. So if the entity has a choice of settlement, the entity shall account for the instrument initially either as liability or equity, but not both. So in other words, the instrument is not a compound instrument. If the employee has the right to choose the settlement, the entity is deemed to have issued a compound financial instrument. Thus, the instrument is accounted for as partly liability, so this refers to the cash alternative, and partly equity, so the share alternative. The equity component is the fair value of the whole compound financial instrument, plus the fair value of the liability component. So we have to note that the equity component is always the residual amount. On the other hand, under the PFRS for SMEs, the entity shall account for the transaction as cash-settled share-based transaction unless the entity has a past practice of settling by issuing equity instruments, and the option has no commercial substance because the cash settlement amount bears no relationship to and is likely to be lower than the fair value of the equity instrument. Thus, the entity accounts the transaction as equity-settled share-based transaction. So, I guess that is all for our group, and thank you for listening.